I am Khushbu Jha. I'm the CEO of BuyProperly Limited. We are a platform for fractional investing in real estate, allowing people to own properties starting as little as $2,500 through the process of fractional investing. Because the problem today with real estate is it is expensive and inaccessible and has too many complicated processes around it. Today's panel is about discussing millennial and Gen Z needs and to see if the traditional institutions, and if they are, how are they serving these young customers, or whether they are missing out. And we are fortunate to have two esteemed guests on our panel. And I would like to welcome our guests today. So our first guest is Mahima Podar. Mahima is the Senior Vice President of Digital Banking and Strategy at Equitable Bank, a completely digital bank, no branches, and no face-to-face requirements for opening an account. She's been instrumental in driving huge growth for EQ and launching several new products for the bank. I mean, delivering high performance is nothing new to Mahima. Prior to EQ, she was leading financial services at Boston Consulting Group, has an MBA from Kellogg School of Management, and an HBA from Ivy School. So please give a warm welcome to Mahima Podar.
Hi, everyone. Thanks so much for having me today.
The second guest is Puya. Welcome back, Puya, on our panel. Puya is the Vice President Strategy at Scotiabank. He leads the strategy team there and has been a key force behind several transformations that the bank has rolled out in the last few years. Prior to Scotia, Puya was a star performer at Bain Consulting. He has an MBA from Ross School of Business, University of Michigan, as well as a master's in mechanical engineering from McMaster University. So welcome, Puya. I am hoping this is going to be a well-debated topic, the two of you representing a traditional and a digital bank. So let's
looking forward to it. Although I would caveat that we own a digital bank as well. So yeah. Anything, I'll just hide behind Tangerine whenever. Thank you for having us.
Thank you both. So we'll start by, I think, the basic question that do you believe that challenger banks and the neobanks and fintechs like ourselves have been able to actually capture share from traditional institutions, especially in the context of millennials and Gen Z?
Yeah, why don't I go first? So I guess I can say from experience, I'm confident that we've been able to capture market share. So EQ Bank is at $4 billion of deposits now and about 150,000 customers in Canada. And so if we look at where our deposits are coming from, maybe not surprisingly, actually Scotiabank is our biggest driver because probably of Tangerine. So I can say, like, without doubt, there is some capture of deposits from the big six in Canada. But admittedly, like, I'm sure it's a drop in the bucket for big players like RBC, TD, Scotiabank. When you think about how much of the assets in Canada are held by the big six, it's closer to 90% of all Canadian assets sitting with the big banks. And so while you have challenger bank players like EQ Bank that are starting to maybe eat away at the margins of market share for the big six players, it's going to take quite a massive revolution before I think the big banks get worried, which, to be honest, is a benefit for us because it means we can continue to innovate and try and push the boundaries without getting a lot of attention from the incumbent players. In terms of your question around Gen Z and millennials, the vast majority of our customers are millennials. So between 25 and 40 years old. So digital savvy, again, millennials, but surprisingly, we are seeing quite a few older Canadians as well. So the majority of our deposits actually come from Canadians who are between 45 and 65 years old. And that's probably because of amassed wealth. And then we are seeing some older Gen Z, more in terms of numbers and less in terms of deposits, but we are starting to see Gen Z care more about the value equation as it relates to banking.
Okay.
Yeah.
Yeah, what's your take? Do you agree completely, or would you like to contend that and say that it's not necessarily true overall?
No, yeah, like, so look, my view is that there's a role to be played by fintechs, by challengers bank, and keep in mind, I think sometimes people think the banks, the big five banks, are slow. Like I contend that I would say there's a lot of energy and investment and a lot of like talent and tech talent that focus on solving like the same problems that fintechs look at in the bank. And I think it's a good ecosystem at the end of the day for the customers, that we all, the banks and the fintechs, all try to basically solve the next big thing. Now, and I would say the programs at the banks that are focused on Gen Z, that are focused on digital only, are pretty successful. Now, sometimes in the press, you hear like, I don't know the numbers for Equitable Bank, but I give another example that I'm more familiar with, like Simple, and say, oh, they grew by 100%. Saying, yeah, we have, like Scotiabank has programs that in absolute dollar, they're digital, and in absolute dollar are very similar. So does RBC, so does BMO. Now, where it kind of doesn't get the same headline, that given the base we have, we can never say, oh, 100% of our growth comes from digital, because the 100% growth in an RBC or a Scotia or a TD means a different number. But I honestly don't think that in terms of focus and in terms of investment, there is much of a difference. Now, for the bank, there is a little bit of a legacy issue that we are not more regulated, but we are a little bit bound more by regulation because of our sheer size. And we are also a little bit more bound by our legacy systems. And it was very interesting. I was reading like an article about tech industry, that even the startups after 10, 15 years get bound by some of their legacy systems, because the challengers, when they start and architect their kind of foundation of their technology and platforms on the new technology, they're by essence a little bit more nimble because they don't need to carry all the weights. But at the end of the day, I think it's fintechs and challenger banks play a great role, keeps the market dynamic. But I don't think it's true that the banks ignore that. Like, it's not by no means that, oh, the banks are like business as usual and ignoring that fact. Now, if someone comes with differentiated idea that that can capture huge market share, yeah, that can happen. Like, that can be one of the banks. It could be one of the big banks coming with that big next big idea, or it could be one of the fintechs. So far, what we've seen is, even though there have been a lot of progress, there hasn't been any groundbreaking market shifting idea. And if there are one or two that like digital only wealth advice in US, it's interestingly, it was done by some of the big players. Like, you can argue that one of the best example of digital advice or digitally enabled advice is done by Vanguard, which is like one of the top 3 wealth advisor asset managers in the world, which shows you that it's not. So the differentiate is, digital and technology going to be a big part of future of financial institution? Yes, but who's going to win in that depends. Whoever spends more and has the best idea. I think the notion that necessarily it's going to be in a startup might not. That's the part that I don't know. It might be a startup, it might be one of the challenger banks, and it might be one of the current players that come with that next big thing and wins using digital.
So look, I like totally agree with you in terms of ability to spend. Like, compared to the big banks, like challenger banks or fintechs are nowhere near in the same position around ability to spend, right? Like I think Scotiabank is spending close to 5-6% of revenue in digital and tech investments. There's absolutely no way that a player like EQ Bank or Equitable Bank can compete with that. But the challenge also for a player like us is we're under the exact same regulatory regime that Scotiabank is, right? Like we're an OSFI regulated bank, we're a Schedule I bank. And so you have the same restrictions that the big banks are up against, but you don't necessarily have the same level playing field. So there's like capital advantages that the big banks have. There's access advantages such as like Interact, for example. And so,
yeah,
I mean,
like, and on the other side, you don't have the legacy. Yeah, like that's. I think that is true for any industry. I don't argue with you on that. Like that's true in any industry. Like the established players have a little bit more capital, but they also have a little bit of legacy. And you're right, you guys are on the same regulation, but the risks of getting something wrong in a Scotia bank or banks like bigger banks is just larger. Yeah, like it's larger. So that's why they need to be a little bit more prudent. And the challenger banks and some of the startups, maybe not like, look, Equitable Bank is kind of in the not, it's in the mezzanine space that, oh, it's big enough that there's something big at risk. Some of the startups are a little bit more nonchalant on, like, they can be, yeah, they can take risk because what's the worst that can happen? They close its idea and it doesn't work. But for Equitable Bank, the risks are higher. For the traditional banks, the risks are much higher. So there is pros and cons. I agree with that. Like I agree with that for sure.
So speaking on startups, I can speak on the behalf of the startups.
Yeah.
We have the same regulations to go by. So when I want to work with a bank, and in my mind, I have had a conversation on this before. Like the kind of things that we are asked across the banks, not just EQ, but in general, is do you have 3 years of audited financials? And you're like, we've not been in existence for 3 years, but in the last 1 year, we have done so much. So I think the requirements in the process, I think sometimes isn't as easy for a startup to fulfill as it is for us. So Scotia Bank, or yes, EQ is a little advanced already, but it's easier for a larger bank or a larger institution to fulfill than for a startup. I mean, the risks are of survival for a startup, to be honest. Nobody knows what you have to.
No. I like, maybe I don't mean the personal risk. I don't want to actually undermine the personal risk that you take, but financial risk, yeah, that on an absolute basis that organization takes. Like, look, someone once told me all the companies are an option with the price of the bond price of 0. So that means different for like a startup than like a Scotia Bank than an Equitable Bank. So that means the management needs to be a little bit more worried about drops and kind of backlash. But again, I agree that it's not easy. Financial regulation and financial landscape, it's not easy for anyone to innovate in, including the banks. And you can have a philosophical discussion that is it the right thing or not, because you can also argue that you're dealing with people's money. So maybe it's prudent for this to be heavily regulated, because if you get it wrong, it's not a widget. You're working with someone's money that might not come back, and everyone has the best intention, but sometimes even best intention can go right. As like there are a lot of examples of it in startups. There are a lot of examples of it in like established banks. Yeah. So.
Fair enough. So talking about innovation, what do you guys think is the top things that millennials or Gen Z looks for in a financial institution or any fintech for that matter? Like for me, when I moved to Canada, I was surprised that I couldn't do online bank transfers for so many things. The fact that I needed to go to the branch for so many things, it was a big change. to get used to that. But I think the default expectation, if you ask me, was like, I shouldn't have to go to a bank branch ever. Like, I think I went once in US and once in UK the first time, and that was it. And then for all the other years, I never went back to the branch ever. So that is one of the things. Of course, being on phone helps and all of that. So what is it that people are looking for from institutions nowadays in terms of convenience, access? Not that the old requirements of security has gone away.
Yeah. Honestly, I think, like, I'll start with that. I think generally the research that we've seen, people want to have the choice, to your point, of if they choose to don't go to a branch, they can get access to that. If they choose to do everything digitally, they have access to that. And if they choose to use digital channels but get advice, because sometimes, like, some of the financial decisions for some of us, it's more complicated than just like researching something on blog. You want to talk with someone, but you still might not want to go to the branch to talk to someone. And right now, there are a lot of efforts to say, how do we use our kind of human resources, but digitally enabled? Because I really think there's a big role for advice, especially as the needs get more complicated. Yeah, like there is like a bread and butter banking needs that maybe you have in your early 20s. As your kind of life gets more complicated, your financial needs more complicated, then there comes a point that some of us might be very comfortable doing our own research and taking our own decisions, and that's totally fine. I actually think the market is very mature if you're like, especially on the wealth side, if you want to make your own decisions. Like, the discount brokerages are pretty mature in the market. Where it's less mature is if you want digitally enabled but advice. Where it's less mature if for onboarding, like if you want to open an account, after you open an account, you can choose not to go to the bank for most of the things. But some part of it driven by regulation, some part of it driven by lack of investment of banks. You still, like, sometimes you still need to go and show your ID somewhere. And I think I would say COVID is making a shift in that paradigm. Like, it makes a paradigm shift. Regulators understand that they cannot mandate that. And keep in mind, the mandate of having someone physically check your ID in Canada, it comes from you prevent frauds as much as you can. But other markets figured it out. There are like digital ways of doing it, and I think COVID at least made the situation a little bit more open for all of us to go that way. And there's a lot of, like, I think Scotia now launched like a digital onboarding, and not just us, like lots of other banks kind of started to do that. Why we couldn't do it before? Because before it was not acceptable. Yeah, even Tangerine, I'm sure Equitable Bank is the same. You still need to go to like a you need to go to Canada Post to show your ID. That's like, they have agreements. So you need to go to somewhere, even though they don't have a branch when you open an account. And now there are like initiatives in play to kind of get over that hurdle. And it doesn't come without risk, but I think we are making progress. But you're right, Canada is probably behind lots of other markets, especially like Australia, Southeast Asia, US to some extent. US is a little bit of a hit or miss depending on where you're in US. But you're right, definitely, Canada is a laggard in terms of digital, partly driven by regulation, partly maybe lack of competition, I think, or not as vigorous.
I think you just hit it on the head right there.
No, that's the truth.
Yeah, like,
you would have a response, because Mahima, I opened the EQ Bank without going anywhere.
Yeah, I think that's exactly it. Like, I think it's our responsibility to innovate on what has always been the case in Canada. So we have been doing digital onboarding since day one, and EQ Bank has been in the market for 5.5 years now. It's true that for 10% of scenarios where we can't find a way to identify a customer, they would have to go to Canada Post to show their ID, but that is like after every other option fails, and it's definitely something that we try and innovate against to remove that friction. But to Puya's point, like, I agree that Canada is behind, and Canada is behind because in general, we are complacent as a population. If you talk to the average millennial, the belief is that all banks are the same, or there's no real benefit in switching from one bank to another. And I think that's probably been the case for a lot of years, and at least in terms of the big five incumbents. But what we see that millennials, like, what are they asking for? At a minimum, there is this need that for everyday banking, there should be no monthly fee. It's become a base requirement that there isn't monthly fees or service fees tied to bank accounts, especially digital bank accounts. So I think that's like a baseline component. The second piece is low cost in general. So what are the other fees that I'm getting charged? Again, like EQ's value proposition is no fees on the account, so no transaction fees, etc. The other piece is like, where else can I get value? So at least our millennials are asking for, where can I earn more, save more? And so we're doing that through higher interest rates. And I think that's becoming more and more prevalent among millennials, especially given COVID and the value conscious reality of what's happening. And I think the third piece is around customer experience and how do I have a seamless, frictionless experience, not only in onboarding, but as I go through the process, right? So I think advice is one thing, but for everyday banking, millennials are understandably wanting to avoid branches and in-person interactions, and then also like phone interactions and call centers as much as possible. And again, so that's what we're innovating against, is how can we enable as much self-service as possible, everything digital online, to avoid that phone call, to avoid that visit. And then agreed around like value-added services and in-person interactions are a different animal.
Yeah, no, I don't disagree with that. Like, look, I don't disagree with that. What I would add is that digital banks, yeah, and Tangerine included, they also, I want to choose my words rightly, they also go on the shoulders of the branch banks. So they only can exist as of today because everyone also has bank that when they need a cash or they need to wire something, they use that, and then they want something that is free and digital. That's why I say it's about a choice. Like there is not a lot of people that have digital banking only, because it puts you, and there is a reality, financial reality, of running branches cost money. Yeah, like it just costs money. It is much more cost efficient when you don't have to have physical property. But there's a value, there's a reason they're there. Like, and I'm sure that we've been through optimization, using digital, using like even ABMs over the last 20, 30 years, reducing that cost. And look, I would say overall the cost of like day-to-day banking has dropped. Is there more room? There's definitely more room. Yeah, there's definitely more room. Some part of it, it's comes from like competition. Yeah, like competition and the pressure you get. I don't think like probably US has the same cost base as we have, and day-to-day banking is cheaper there. Yeah, why is that? Because it's more competitive, it's more fragmented. The big five banks there have about like 20% of the market, 20-25% of the market, compared, as you said here, like between big five bank across anything, we have over 90%. So it's a little bit more concentrated.
So like, to understand that there's a cost base, but aren't Canadian banks the most profitable banks in the world? So you're still turning around and turning 0% deposits into like lucrative lending businesses, both personally and commercially, and then generating like huge returns on equity. So like, it feels like the equation is more when is the value equation going to be shifted from the bank as the institution or the shareholder and back to the consumer.
That's right. Yeah. So, and that's usually driven by the market. Yeah. So as any, and I'm sure you are the same, like we are there to serve the customer, but also at the end we have fiduciary duty to our shareholders. Yeah, like that's basically, and that means to maximize the return while serving our customers and kind of thinking long term. Maximizing the return of the capital is at the, which is at the bank's basically management can play with it, which is basically driven by shareholders putting that money in. Yep. Like there is, I think the flip side of this, everyone forgets that. Look, when we say shareholders, everyone thinks there's like a tycoon sitting somewhere that owns like RBC and Scotiabank. You guys probably know that the majority owner of all the banks are pension plans, like pension plans, Fidelity pension plans, like Canada pension plan. And they use this as a dividend and to kind of pay the rest of Canadians. So it's not as if like, oh, there's like a tycoon sitting there. And you're right, can it go down? And is Canadian banks one of the most profitable in the world? Yes, they're up there. Like Australia is pretty good. We are pretty good. And you can see there's like markets that are a little bit more concentrated, less competitive. And I would say few years back, probably US banks, like, and I mean 10, 15 years down the road, they had similar like profitability. And then the competition basically raised in US, and they had a declining return on equity. And we had a declining return on equity, to be fair, like in Canada as well, at not at the same rate. Let's say that. Not at
I guess it's the lack of competition, because if you look at the UK, you have banks like Atom and Monzo who provide all the service. But here, I cannot move money without being charged. Actually, I cannot move money more than 3,000 at a time. For everything, there's a charge. There's a transfer charge. There's an incoming charge. There's an outgoing charge. And so it feels like it's a big money-making machine rather than serving customers as such. So,
no, I disagree with that.
of customer experience, you are kind of have no motivation, I think, as large banks to actually do it differently. So that's probably one of the reasons why I feel a lot of the millennials and especially Gen Z are like a little anti traditional banks. I mean, there's a survey which said that 60% of the customers would be happy to ditch the traditional bank and just bank with an Amazon or a Google or one of the tech companies, because they are assuming that these guys will at least innovate and try and reduce costs for the customers. So I think it's probably the lack of competition that's preventing the innovation, and the rest is kind of the justification of why we are not moving.
No, but like lot of things that you say, there's no innovation. Like price cuts are not necessarily innovation. Yeah, like you can price cut tomorrow and don't charge for something. Like there are two things. Like we are like, I think, mixing A and B.
Yeah,
and
I was going to
like
say
price cut. There's like innovation. These are two different things.
True.
And price cut can happen tomorrow. Like tomorrow, if everyone cuts the credit card like fees or checking fees, yeah, like everyone cuts it. Like it doesn't take a lot of it doesn't take a lot of time. It's going to be pressure on the shareholder, and I think you really forget the shareholder side, that you cannot do these things just like cutting cost only, like just seeing one side of the equation is not right. But do I agree that if there's more competition, there would be more pressure to do that? For sure.
So I think the issue is though, like Canada is not really open to competition. Like you have a regulatory regime that protects the big banks. You have an oligopolic mindset. So I think you're right. Like the whole system is protecting big bank profit pools, which fine ultimately go to the shareholder. But you have like a
yeah. An economy, like it's again complicated equation. Yeah, it's a very complicated equation. I don't disagree, again, competition, but keep in mind the impact of competition is when you cut costs, like how do you cut costs? You cut people. Yeah, like you cut employees out of like one of the implications of digital that people don't like to talk about, that look, a good portion of Canada's economy is employed by the financial institutions, whether directly or indirectly. Yeah. So cutting 50% cost, where do you think that cost comes from? Like, yeah, where do you think that cost comes from?
Yeah, so I mean, okay, I'm sure there's like government pressure on employment because RBC, for example, is one of the biggest employers in Canada, but that's not a good reason to keep padded profit pools, right? So
that cannot be sustainable in the long run, because when the moment you're changing processes, making processes efficient would, yes, change or shift that employment towards other industries. So it's like saying if the factories were doing manually, they would employ more people, but if you bring in automation, it will employ less people. And we are getting into a completely off track discussion, but I think the thing is that
I don't disagree, but I don't disagree with that. But I think where I take issue with it is that, oh, like these are big old banks that are trying to screw customers. It's not as like, because this is the first thing that happens in any competitive environment, including US. The management, as they should, if they get price pressure, what do? They get the cost. You're right. You say in the long term, economy adjusts itself. But then you can say, look at the regulator. You can look at the government. Don't make it, oh, it's just big bad banks. Like, don't try to screw customers and they charge them a lot. Like, and look, we own Tangerine. I would say our pricing is better than Equitable Bank on Tangerine side, like, because we have a different cost base on Tangerine side. Yeah, we have probably the best, like, Visa card, everything for free. It has a different cost base. Yeah, it has a different mandate. So
wait. Tangerine pays 20 basis points on your deposits, and we are paying 1.7%. We charge nothing for e-transfers. We allow free EFTs.
We don't charge anything for e-transfers either. But let's not get there. I don't want to
I think we are getting into this heated debate of which is better, Scotia's Tangerine.
No, but I'm just like, the point that Tangerine is lower cost than EQ is just like.
It is. I think it is. But anyway.
Yeah. We have a few questions on this one because we are debating this. One of the questions is, how do you communicate the value proposition of the existing regulatory regimes to an average customer? So that's the first one. You guys have any thoughts? Because we've been talking about defending, like we have been defending the current setup, but then how do you explain it to an average customer as a value proposition is the catch. And then the second question is,
honestly, the value of regulation is very hard to measure. Like, yeah, but you can at least, you have couple, and I'm not defending it. Honestly, I don't know what's the, and you keep in mind, sometimes banks also argue for, like, if you give us a little bit more leeway, we can innovate more. Yeah, banks are also on this side, but you can also look at 2008, say which one, like Canada was one of the few countries that because of regulatory pressure and banks being conservative, nothing happens to the economy. Now, like, what's the value of that long term? I don't know. Like, was it because of the regulation? Was it because of the economy? Was it because of the banks being a little bit more more risk averse in culture? It's yeah, it could be any of the other ones. But we can say for sure for some of the capital and liquidity strictness that they had at the time, we prevented basically a disaster from happening in Canada. Canada was like generally unescaped, like from 2008 financial crisis.
So, I mean, I would agree with you. Like, I think that the regulatory oversight in banking is critical, right? So, I think liquidity and stability of the financial sector needs government oversight, and so that should never go away. And things like CDIC insurance, so Canada Deposit Insurance Corporation, that provides up to 100,000 protection on your deposits is quite valuable because it means that the individual consumer doesn't need to do a bunch of research or get comfortable with a given entity, knowing that there is this protection provided by the government. I think the main deficiency is this notion of encouraging more competition in the financial services landscape. So for example, the UK has this challenger bank license, right? So it enables neobanks or smaller entities to participate in deposits and lending easily and cuts out a lot of the red tape. If Canada moved to something like that, that enabled more players to have access to the infrastructure, I think that's when we start to see real pressure on price points. We start to see real reimagining of the customer experience and the processes.
Fair.
Yeah, I don't disagree with that.
Sorry. Fair enough. There's a question, I think probably for you, Mahima. Do you think that challenger banks will ever expand into physical banking at some point in time to provide an omni-channel banking option to their customers? I know the UK ones haven't yet.
Yeah, I mean, I think it's a really interesting question because it's an ongoing debate that has had. So there is this argument that after a certain point and scale, you need physical presence to give consumers this sense of security that you're a real and trusted entity, and that if something goes wrong, they have somewhere to go. So that has been the real value of branches in the Canadian, sorry, that's my mouth, in the Canadian landscape, or even like the international landscape. Our argument though is that outside of this marketing value, branches don't provide any real purpose in everyday banking. And so the incremental investment required for that marketing or sense of security isn't worth it. So at least EQ Bank will not move to branches or physical entities, but I do understand or appreciate that some challenger banks will make that move because you do get that incremental lift or growth once you start to establish branches.
Like the UK ones did not. So the Atom and the Monzo and the Revolut have actually not started building physical branches in UK. But if I draw a parallel in the tech industry, for example, Amazon has ventured into some sort of a physical presence with Amazon Go stores. Warby Parker, which was a glasses or spectacles seller, a direct to customer, has now opened stores, and we have one actually in Toronto. We have two in Toronto now. So they have moved into physical stores, even though they had a whole online presence. But I'm wondering if there's a divide between something that's a more consumer product, like a pair of glasses, versus a financial services product where you can actually not need to physically, like I don't need to physically count my money technically anymore. So maybe we can just
also, once like these banks want to move into deeper advice, or if they move to deeper advice, then I can see the need for branches, but the UK banks haven't done that. And I also wonder, because the UK has open banking and this idea of data portability, does that make people more comfortable? Does that reduce the need for physical branches?
Yeah, to add to what you were saying, so if there's no physical banking, there's another question which says, are there any differentiators for challenger banks that differentiate them apart from, so if you keep the prices and the costs aside, are there other differentiators for the challenger banks, given that all their services are digital?
Yeah, I mean, I think it's like entirely around customer experience, right? So I'll give you an example of, we have an international money transfer capability on EQ Bank. You can send money to almost anywhere in the world instantaneously. It gets funded from your account immediately, and like when I send money to India or the US, it's there in 30 seconds. And like there's still that value equation on top of it, right? So in a few clicks, I've sent the money, it's super seamless. And the exchange rate that I'm getting charged is the par value. So there's no spread built into that foreign exchange, which is pretty remarkable when you think about the economics around international money transfers, and that there is a service fee, but it's small and it's completely transparent. So you know exactly how much you're sending to the other country. And again, it's there in like a few seconds. So I think there's tons of room for competitive advantage in the challenger banks, but it's all around bringing to life that value proposition and then having a seamless customer experience.
Right. I mean, I'm completely aligned on the whole customer experience piece, because like even for us with BuyProperly, the core is to make sure that people don't have to go to the house, don't have to deal with agents, and making the whole experience simple and seamless, because you can do the whole transaction completely online and not have to do anything at all. And then the second piece that you touched upon, also something that we strongly believe in, is the transparency piece. In fact, we've got this as feedback from a lot of customers that there may be costs to owning a real estate investment property, but then those costs are listed out down to the T. If we got a cashback, if we got a discount, everything's listed out there for the customers so that they know what they're getting into. Doesn't mean that we are free, but then whatever it is, they're making an informed choice, and it's all upfront and stated, rather than being hidden or on the side or not clear or built into another cost, something like that. Before we move on to another question, probably the next one's for Puya, I just wanted to see if people are familiar with some of the fintechs that we have around. I'm hoping some people are familiar with us, at least. We would really want to increase awareness, but we acknowledge we are still a new way of buying real estate. So just wait, give people 60 seconds to vote on this, and then we can move on. We have a lot of questions coming in. Rest. Well, simple seems to be the most popular one.
I feel like people know about EQBank because I've been talking about it for the last.
Yeah, maybe we should have done this before we launched it. Next question, I think probably for Puya, but what are some of the key innovation projects that big banks are working on or betting big on? Because you talked about how even the big banks are looking at a lot of innovation and they're continuing to chug. It may not be easy for them to change everything overnight, but they're definitely working on it.
Yeah,
is there something you would like to talk about?
I'll give you a couple of examples of things that happened and things that we are working on. So, like, for example, over the last year, and this is pretty new, over the last year we launched eHome, which is like you can get the mortgage all digitally back to back. Yeah, all digitally back to back, like on a Scotia Online platform. You can renew your GICs, or you can renew if you have a mortgage with a Scotia Bank, literally 3 clicks on the mortgage without any documentation, kind of online. So there is that's where I say there's a lot of focus, yeah, but it doesn't get as much sunlight because it's one of the 300 things that bank does, versus when you become like a challenger bank, you do very specific things, you do them well, and that becomes your story. There's nothing wrong with that. I don't want to undermine. You do something nice, you should get credit for it. But at a bank, this is one of the many things. Yeah, like this is one of the many things that can be done. These days, there's a lot more focus on advice. We are just launching Advice Plus. This is kind of using the digital tools and the branch network to give better advice. There is a lot of focus and investment in analytics to be able to serve clients better. When someone comes, don't rely, because it's very hard. Like I would say, we do it very well on the wealth side when you have assigned like advisor, and they know you. They just know Khushbu, background, everything, and they have the experience and give you the right advice. But sometimes when you deal with 10 million customer base, it's very hard for your 5,000 advisor base to know 10 million customers. Like completely. We know some of them, and there's a relationship. So you need to invest in analytics to know and try to discover and try to help the client. What's the customer? What's the next best action for them? What their needs are? Discover them. So there's a lot of investment in analytics on the retail side, and there's a lot of investment on the wealth side on digitally enabled advice, making the customer experience more streamlined. And again, where it gets tricky, just to give you a sense, is that, look, given all the legacy systems that we have, sometimes doing a small thing costs a lot of money. Yeah, because it's not, there are systems, wealth systems from 1960s, like that. Yeah, there are clients from 1960s. It's on that system. So upgrading those systems that were written when before internet was a word, sometimes it's not as easy. But there's a lot of investment to make sure that we can deliver that customer experience, and innovation on self-directed planning, augmented by advisors, can have set goal plannings for different goals that you have in life on the wealth side. And again, on the retail side, it's more about analytics and trying to kind of have that meaningful conversation. And given again the sheer size, that's a big project that we're working on as well.
That's awesome. Yeah, I mean, talking of legacy systems, I used to work at Amazon before, and we complained of legacy systems all the time, which now in context seems rather odd, but we were always complaining how we are not able to do a certain thing because it's just legacy systems that's holding us back from being having a fancier interface, having a better database run, and all of that. So, and then Amazon's been around for only 20 plus years versus several decades, like some of the big banks.
Yeah.
That's a fair one. But talking about innovation, I think one key thing, and you've talked about analytics and the data access, Maima, you've talked about it, with open banking coming soon, hopefully. The last I heard, the task force was stalled because of COVID, but I am hoping that that will eventually be unblocked. How do you see the landscape evolving from both the fintechs and the challenger institution perspective, as well as the traditional perspective? I'm hoping it will bring a lot of good because I'm on this side where we don't have access to the data, but
Yeah.
what are your perspectives?
No, I think open banking honestly can have huge impacts, because you don't have any data, but we also don't have complete data on our clients. Yeah. And all of us think, all the financial institutions, that if we have a better view of the customer, we can serve them better. Now, who's going to win in that? Honestly, I don't know. It's really hard to say who comes with that, who basically be able to address and use that data differentially in a sustainable way, which also, because as you probably appreciate, Khoshbu, working for Amazon, that there are analytics that you do that are good, but might kind of make people uncomfortable. And so it's a little bit of your capability and how you kind of handle it, and how does the customer kind of handle it, and what's their perception and their readiness. And I don't think the society is kind of very homogenous on that. Yeah, you have younger people that might be very comfortable, and you have demographics that, rightfully so, they're not as comfortable with that. So I think we would have a transition period that we learn how to deal with the data as a collective of the industry, and the customers need to try and test and see if they get comfortable sharing their data with other banks, with the banks that are not their clients. And even on the optic of that, how much customer basically enrollment you would have, because they need to give the consent for the data to be shared. How much of that you would have? That would be interesting to see, honestly. I think we don't know. I'm sure over time people get more comfortable, but I don't know if it comes into play. What's the short-term impact? Long-term impact, I think I agree that it's going to be, at the end, there would be value to the customers, and there would be long-term acceptance. Short-term, I honestly don't know. I don't know.
Yeah, I mean, like, I think from my perspective, the clear winners in open banking are the consumers, because in all cases, it should create an environment of innovation and insight generation. So now that you have data portability, it should give new players as well as the big banks an opportunity to innovate across that data and provide insights to customers that they didn't previously have access to. I think the other reality is it will make switching and trial of new services much easier. If you think about like how much repository there is with your primary banking institution, if that can be seamlessly ported to another competitor, I think that will open up the notion of choice and remove friction. And I think that the thing about open banking is if we can get a regulatory oversight on open banking, it gets rid of some of the pain points that Puya is talking about, right? Because you have a liability model, which means the consumer is always protected. You have a governance model that ensures that bad actors don't get into the system. And then you have easy consent and also opportunity to take away that consent in a centralized fashion that makes it really easy for consumers. So from my perspective, as long as we put open banking into place with the proper regulatory oversight, I don't see any downside, because it's much more secure than the current environment where you have 4 million Canadians relying on screen scraping, for example.
For sure, that is for sure, yeah.
Yeah, there's another question which I really like. Are the challenger banks trying to offer real estate services, investments online in some way, or is that not the focus for now? Before Mahima, you say yes, we definitely do. So I don't know about the banks, but we are offering an investment option. It is simple, straightforward, transparent, and if you haven't yet tried it, you should probably go to buyproperly.ca and try it out today. We are bringing in new deals all the time, and it is as seamless and as simple as it can potentially get. I think half my team is Amazon, so we think like that. So the intent is to make it similar to buying on Amazon, except this time you're buying properties and shares of houses rather than products. But yeah, question probably for you, Mahima.
Yeah, no, I think there are some great point solutions like BuyProperly. I think they're like Wealthsimple is obviously not a challenger bank per se, but a fintech that's approaching both discount trading or free trading as well as robo advisory. I think the challenger banks, or like let's call them the smaller banks, because to me in Canada, EQ is probably the only challenger bank, or the only ones that identify themselves as a challenger bank. So like the credit unions and the smaller banks are getting into investing, but the one thing to watch out for is, are those products like bank products? Are bank mutual funds being sold, or are you being, do you have a whole marketplace available to you, right? So those are the things I would watch out for as you look to start investing on a given platform. My approach, or like my team's approach on EQ Bank, is if we move into these offers, so let's say equity trading or ETF trading, it will be through like marketplace developments. Like we don't want to only be putting EQ Bank products out there unless we are confident that they are extremely high value and transparent. So for example, we have fixed income, so like GIC offers on our platform that are extremely easy to buy and renew. And we're also confident that they're top of market rates, right? So that is a place where we have no issue just putting our own products on the platform. But again, like if we get into real estate, so more like mortgages, we intend on making it a marketplace. If we get into equity purchase or mutual funds or ETF type products, it's going to be more of a marketplace versus us trying to sell our own branded products, unless we find some way to add very obvious value to the consumer.
Yeah, talking about financial advice and investments, I thought it's it's worth checking. What do people really want in terms of financial advice? Who do they trust? I feel like there are enough industries out there that work in conjunction with the financial institutions, banks, both challenger and traditional banks, that could benefit from some of this. Like us, for example, it's not like things that we are doing, as Puya said, that maybe startups focus on one small area and try and do it really, really well. But then if you are thinking about the whole ecosystem from the customer's perspective, then you would want this to fit in with the rest of the things that they have happening in their lives. So like if we, for example, open a wallet, we would want it CDIC insured or backed by one of the banks to let people put money in the wallet, but rather let the banks handle the back end or the storage of the actual money than us doing it. So I think there's a lot of room for that as well in general, across services. So not just in financial advice or in deposits, but across a lot of archaic industries, there's room for doing something together with the banks. Which kind of takes me to the next question on what you guys think. Is there scope for startups and fintechs to work together with the traditional institutions and coexist? So we've spent the whole 1 hour just talking about who's better and who has better rates and why and all of that. But maybe there's room for coexisting and working together. The question is, if startups like us, for example, start working with banks, say the big 4, big 5 banks in Canada, would that kind of destroy trust in us that, hey, we kind of tied up with the big banks, so we're probably thinking like them? Or would it build trust in Scotiabank? Like, what do you guys think about that coexistence and symbiosis?
I'm going to throw Leah.
Go ahead.
Yeah, maybe this is not what you want to hear, but I actually think the startups or the fintechs or the challenger banks get credibility by working with the big banks, right? Like, there's no argument that these are long established, trusted organizations in Canada that have huge foundations. And so I actually feel like the advantage of a startup working with the big banks is credibility. It provides backing, and if you can end up in a distribution agreement, I think you're laughing because you've now just opened up your access to clients by probably 1,000 times what you would have been able to get access to before. I think the challenge is probably on the big bank side is the name of the game is client acquisition, right? So nobody really wants to be the back end pipes for this seamless customer experience, and like it's all about who owns the customer relationship and who has that loyalty. So I think where the big banks struggle is they already have like millions and millions of customers. They have that entrenched relationship. What advantage do they have by introducing a fintech who could then start to take away from that potential relationship? And there's so much scale that I think there's this notion of we can build it ourselves, which is harder than I think anyone realizes. And like, how do you find the right mindset and the right team? And how do you get rid of all the red tape in an organization to enable that? So I think that's some of the challenges, but I definitely don't think that there is a reputational concern by partnering with big banks if you're a startup.
No, I think you're right on. I agree. I think if anything, is like it would give credibility to startups. And look, again, we hear a lot of like bad news on banks, but the other thing that I think as people like to educate people, a lot of Wolf of Wall Street things that you see. First of all, they're investment banks. That this is not like branch banking, like it's bankers.
Hey, don't you have a capital markets division?
no, there is a difference. That's the difference. Like banking, the majority of banking is not that. It's not everyone like driving a Ferrari. Honestly, it's more kind of your normal Canadian, the average Joe. Those are our advisors. Like I think we've seen so much Hollywood that sometimes that skews our view. I think there's still a lot of trust in the banking industry. Do they want us to innovate more? I think so. That is true. Like, okay, like do they think, oh, you're kind of good old bank, but not innovating enough? I give you that, but I don't think there's like a mistrust. Yeah, there's a mistrust. Now, when it comes to partnerships. First of all, there's a lot of partnerships. The partnerships generally only work. So I don't think like Equitable Scotiabank can work. Yeah, like because you're offering the same thing. Like it's just more competitive. It's like Tangerine Scotia. If you like something, then you buy. There's a merger. Like yeah, a merger could work, and there's a lot of examples of that. Like Tangerine is like most obvious one, that it was a bank, and we basically merged, and it's part of a Scotia family right now. Now, but there's a lot of good solutions that would be used like as services. Like we have a partnership with Cabbage. We have like when I look at like BuyProperly, it's a product and it's a service. Can there be a partnership on there? Yes, because I don't think bank ever wants to be in the business of running property. Yeah, and I think again, your competition there is not actually banks, it's real estate private banking, private real estate firms who actually do this. And like what you guys are doing, which is great, is that you are bringing it to the masses, because currently you can do this, but you have a minimum of, yeah, you need to have, if you have 250,000, this can be done right now. Like there are like professional real estate management firms that do that, but they have a very high minimum. Like you cannot buy it for 2,500. Now, banks sometimes they're trying to put those on the funds, so it's a security in the fund, alt asset type. There's a little bit of innovation there, but what you guys do is that you kind of go direct to customer. If you gain a scale, can there be like a partnership there? I think for sure. I think like I'm not saying Scotiabank like with any banks, but it's just a skill. Like you need to have this skill and track record, as you said, the 3 years of audit. Like those things matter. Look, just an example. I'm sure Equitable Bank also is the same. Sometimes the length matters. Like right now, even if when we hire contractors, like IT contractors, people pay, like the bank pays extra for Deloitte. Because then there's sometimes another company that can do the same. It's the same engineers, but basically partly because of liability, because the bank thinks if something goes wrong, what do I do with these 3 smart engineers? Like let's say they mess up something, who do I sue? There's no one to sue. Versus if I give it to Deloitte, yes, maybe it's slower and it's more expensive, but I can sue Deloitte, you know, that, and you think it's funny, but it's not funny. This goes into decision making, that continuity. What if 5 years down the road there's a glitch and I become liable? Like how do I make sure there's an accountable firm on the other side? And that's part of it that becomes very real to protect the business in the long term. So so that becomes a big deal. But I think honestly right now as a service, there's partnerships. Again, Wealthsimple, great firm. A lot of my friends work in Wealthsimple. It's a great firm, still a small, but also owned by Power Financial. Like people ignore the fact that startup, they use their startup cachet and say, and it's owned by Power Financial. And there's a reason Power Financial does not merge it with Power Financial, because they want to use that brand cachet, that startup. And like Michael wanted to give this to masses, like that type of a story. But keep in mind, the reason they can invest is that they're like the Murray family owns like 57%, like majority or the biggest share. And I'm not sure if they're majority. They're the biggest owner of Power Financial. They're on the board. And if it really transforms the industry, then they're gonna put their resources behind it and use it as one of their channels. So there's like, I'm saying it's all already happening, and some of it is obvious, some of it is not obvious. Like you might not, like a lot of people might not know that they're that Wealthsimple is owned by Power Financial, and that's great. It doesn't actually reduce or increase their worth of and the value that they deliver in my eye. But again, it's not bootstrap like for the people. No, it's owned by one of the biggest corporations in Canada.
Yeah, I mean it's still independently run though, right? Look, it's
and over like half of the chair, half of the board of directors and the chair of directors are Power Financial and set by Power Financial. That's true.
In the interest of time, I think running a quick poll about us on how people get to know about us. But thank you so much, both of you. I like the heated debate about how the big banks are doing versus what the small banks are doing. I like to side with the small banks and the smaller institutions because I fall in that bucket. But totally cognizant on how very soon legacy systems, for example, start creeping in. If I could see that at Amazon, which is considered innovative and cutting edge and new and all of that, then I can totally imagine that being a concern for a large institution that's been around for a long time. Hoping that all of us next time are talking more about this symbiotic piece that we ended on, where we figure out ways of working together with the large institutions more. And then the second thing that I feel that really deserves a lot more discussion is how we can leverage an open banking era for better customer experience and better services for customers, as well as better analytics for the banks, like you said. So everybody wants, yes, Amazon kind of recommendations on people who bought this also want this, or bought this together with this kind of a thing. But
do they?
Sorry?
So do they really want those recommendations?
But sometimes I think it is helpful because then, like, especially when you have, it's like selling the car with the car seat and the adjacent parts, right? So when you buy the car, they also try and sell you accessories on how you can upgrade the seat cover and how you can add better tires and fancy caps on your tires, sort of thing. It's
you're being
kind of that.
Anyways, we don't need to get into that. Thank you so much for the opportunity. I really enjoyed speaking with both of you today.
Yeah, for sure. It was a great discussion. It was nice meeting you, Mahima, and thanks for inviting us.
Yeah, thank you for being here. And I hope people have had a chance to get to know both the standard traditional banks. Not to say that you don't have Tangerine under Scotia, that's already there, but the image is still that of Scotiabank, and also got to know about what EQ is doing. If people want a referral to EQ, actually, I can provide that. I open an account and I'm doing your free publication, Mahima, there.
That's amazing. There is a refer a friend program, so incentives for all.
Yeah. And then we will also know about us. Thank you.
Thank you, guys. Have a good day.
You too.